What we're going to be looking at here is accounting for contributions or donations, and that would be a non-reciprocal transfers here, and that would be transfers of assets in one direction, such as cash, securities, land, buildings, forgiveness of debt, and so on. And this would be contributions here for companies or between companies here. So let's first look at the case here where donations are accepted or received. This is when a company accepts or receives some donation here. So this is for contributions or donations received by companies here. Number one here you recognize as revenues in the period that was received here. And then number two, you would measure it at the fair value of the assets received here. So let's look at our example here. Corporation A accepted a donation of land here with a fair value of $150,000 from a municipality's Industrial Development Corporation. In return, Corporation A promises to build a plant on this land here. So what would Corporation A would do here to record this donation accepted here? What they would do is they take their land, set up a land account here, and again it's at the fair value here of the land. Again, on our balance sheet we debit it for $150,000, and then on the income statement here the credit would go to the contribution revenue. Again, at the fair value of the land here we'd credit that for $150,000. So this was simple enough here for donations accepted or for donation accepted or received here by a company. Now let's look here at the case here where donations are made or pledged here. And these are again contributions or donations made here by companies. And number one here, you recognize it as expense in the period it's donated. Number two, measure it at the fair value of the assets donated. And number three here, if a difference exists between the fair value of the asset and its book value, then recognize a gain or a loss. So let's look at our example here. Corporation A donates land to a municipality to build a city park. The land cost $80,000 and has a fair market value here of $110,000. So Corporation A would record this donation made here as they would have their land account here, and that's on our balance sheet here, and they would credit or reduce their land account here for $80,000, the cost of the land here. And then the credit, Corporation A would recognize a contribution expense again at the fair value here. Both the fair value, the land is at its fair value here, and the contribution expense is at its fair value. Contribution expense on the income statement, and they would debit that here for $110,000, the fair market value here of the land at the time of the donation here. And then what they would have, the difference between the land's credit amount here and reducing the land here at its cost of $80,000 and recognizing the contribution expense here at its fair value at the time of the contribution here of $110,000 would in this case go to a gain here, and they'd credit their gain here on the income statement on this land here. And that the gain on disposal here is simply the fair value of the land, $110,000, less its book value here of $80,000, gives us the gain on disposal here of $30,000. Again, simple enough here, but just remember when you record a donation, you're doing it here at the fair value, and you're recognizing here as an expense on the income statement. Now let's look at the situation here where, let's go down here and look at it. If the donation is conditional versus unconditional. So let's look at what we're talking about here. If a company promises to donate or pledge some type of asset in the future here, we got two situations we can look at here. Number one, if the promise is unconditional. It depends only on the passage of time or the demand by the recipient here for performance. You report the contribution expense and related payable immediately here. You do it immediately here if the promise is unconditional here. Now number two here, let's look at number two here. If the promise is conditional here, that is has some conditions tied to it here, you recognize the expense in the period benefited by the contribution, generally when it transfers the cost. So we have two situations here, remember, when we're recording a donation. You have to determine here if the donation is either conditional or unconditional, and then you would record it appropriately here between the condition. If the promise is conditional, you do it immediately. If it's unconditional, you do it immediately. If it's conditional here, then you have to wait until the transfer of the asset is made.